Alright, so we're starting with our second video on types of investment. We left off on the previous one with a managed portfolio, and now we're going to go into fixed deposit. Okay, so fixed deposit is exactly what you read at the top. It's a very conservative method of investment. It means you go to a bank and you take a specific amount of money, you deposit it into an account, and it is fixed. You cannot withdraw it, you cannot add to this in any time while it's in that investment period. So you can determine ahead of time you want to invest in this fixed deposit for a specific amount of time, and then in that time you will get a certain interest rate, but it is fixed, and you need to know that the investment is fixed in that period and it is not accessible. Okay, a risk regarding that is there's no surprises. It's very low. You will receive what was communicated, what was promised in the time, in the beginning. So you know what you're going to get out of it. Okay, so they will take your investment and they will run with your funds, but they'll give you, the bank will then give you a fixed return. So how does that work? So the banks then, because you fixed your money, you will not withdraw your money at any given time. They've got a specific, they've got that period to use your money, which they then pool with different other investments they've got. And then for that period, they will also invest in different things, but then they will make money from that and then use the dividends or the rent or the interest income to then recompense you as the investor for your money, for your worth. Or they'll use it to supply other institutions, businesses or individuals that want to borrow money from the bank, and they will pay back with interest. So then they'll use that money to give it back to you, or a portion of it, because they will also make a profit. Okay, so the interest rate is usually fixed and it is not usually affected by market fluctuations. Next one, we look at the 32-day notice account. Now what makes this one different than a fixed deposit is here it's a notice. Here you can give notice and have access to your money in 32 days. Okay, so the bank doesn't have a fixed period. Now you give them 32 days to get the money back. So your money is invested again with a fixed rate, but you can withdraw it in 32 days notice. You earn higher interest compared to your savings or your check or your current account, but it's less than a fixed deposit. The risk, very low risk. Your interest is calculated on the daily balance, and it's increasing on your return on investment. But your interest rate may fluctuate with market condition, which increases the risk, but it's not a big risk. As we said, it's normally invested at a fixed rate. Okay, last one for now is debentures. Now, what is a debenture? This is if you look at the direct translation from Afrikaans, it is a skuldbrief. So that means it's a letter stating that you owe someone money or something. Okay, so why does businesses give out debentures? Now they want to raise capital from the public. Okay, so you as a lender agrees to lend money to a company on certain conditions for a specific period of time. Okay, so you're investing, but you're borrowing the money to the company. You want your capital back plus interest. So it's almost like you agree on a specific period of time. So it's almost like a fixed deposit at the bank, but here you borrow money to a company. Okay, so lenders are also called creditors. The reason being is the company lending is liable and they must repay the amount of the debentures. Okay, most debentures can be traded on the JSE. There you can sell your debenture. It's tradable on the JSE, and then which means it's a asset. The company must repay the amount to the lender or the debenture holder. So if you trade your debenture, someone else gets that, and he can claim the full amount. If you need the money in a shorter term than you've agreed on with the company, you can sell your debenture to someone else for a lower price, because they will want to at least then get profit from that as well, but you'll have access to your money in a quicker fashion whilst also making profit. Okay, so what's the return on investment in debentures? You will receive annual interest payments to the holders, as well as at the end of the period you will receive your capital. Okay, low risk, you need to be paid back, and companies are liable to repay the debenture amount, the capital invested plus the interest, and that decreases the risk of the investor. That means it's a steady income in the form of interest, and you will not lose your capital amount. Okay, that concludes this video. We will start the next one on venture capital.